dear students. Today, we're going to be discussing about evaluating business operations using ratios, particularly profitability ratios. First, we're going to study some words. What is a ratio or what are ratios? Ratios are mathematical comparisons that can be used to provide a very effective indicator of the financial progress of a company at a given time. Next, profitability. What is profitability? Profitability is the degree to which a business or activity yields profit or financial gain. So combine the meaning of ratio and profitability, then you have profitability ratio. Next, financial. What is meant by this word? Financial comes from the word finance. It all talks about money. Financial ratios are one of the most common methods in interpreting and analyzing financial statements. In this course, profitability ratio is one of the four ratios or four financial ratios that we're going to tackle. In doing financial ratio analysis, we will need the following accounting records: balance sheet and income statement. The profitability ratios that we're going to tackle are the following. First, gross profit margin or GPM. Next, net profit margin or NPM. And then, the return on assets or ROA. And lastly, the return on owner's equity or ROE.
We now come to gross profit margin or GPM. Gross profit margin. This ratio represents the average gross profit generated by each peso of sales. The bigger the gross profit margin, the better the company is performing in terms of profit. So the formula for gross profit margin is gross profit divided by sales times 100.
For the computation of GPM, we will need the income statement since the gross profit and the sales is found in the income statement. So we'll be comparing the GPM for the year 2009 and 2010 of Breadwinner. As you can see in the income statement of Breadwinner in 2009, the sales is 600,000 and the gross profit is 225,000. And in 2010, the sales is 1,250,000 and the gross profit is 500,000. So for the GPM of Breadwinner, for 2009, we have 225,000, which is the gross profit, divided by 600,000, which is the sales, times 100 is equal to 37.5. And for 2010, we have 500,000 for the gross profit, divided by 1,250,000 for the sales, times 100 is 40%. As we can see, there is an increase in gross profit margin from 2009 to 2010. But are we really sure that the company is doing well in terms of profit? Let's find out in the next lesson or the next profitability ratio, which is the net profit margin. Net profit margin or NPM. Net profit margin, the ratio represents the average net profit earned by each peso of sales. It reflects profitability after the operating cost of doing business have been deducted from the gross profit. In the net profit margin, this kind of ratio is stricter than the gross profit margin in determining the profit margin of the business. So, let us find out how it is done. So the formula is net profit margin is equal to net profit before tax divided by sales times 100. Looking at the income statement of Breadwinner, we can see that the net profit before tax in 2009 is 30,000 and the net profit before tax in 2010 is 62,500. The net profit margin computation for 2009 is net profit before tax of 30,000 divided by the sales of 600,000 times 100 is 5%. And for 2010, the net profit before tax is 62,500 divided by the sales of 1,250,000 times 100 is equal to 5% also. So as we all notice, the net profit margin is the same in 2009 and 2010, which is 5%. Why is that so? There is a significant increase in sales from 600,000 in 2009 to 1,250,000 in 2010. But why is it that the net profit margin is the same? Let us think, let us analyze. Why is that so? There is an increase in the gross profit margin in 2009 to 2010 from 37.5 to 40%. But why is it that we have the same net profit margin? Can you imagine the reason why is that so? So that becomes now our analysis for these financial statements because of the ratios. This one tells us that there is a significant increase in the operating cost of the business. There is a big increase in sales, but the operating cost exceeds the percentage of increase in sales. So much bigger increase in the operating cost. Even if the cost of goods sold or the cost of sales is less, because there's an increase in the gross profit margin, so meaning the cost of goods sold is less, because there's an increase in the gross profit margin. But the operating cost is big. It is way much bigger. The percentage is way much bigger than the percentage increase in sales. So that is the reason why, even if there's an increase in sales, big increase, more than 50%, more than 100%, I mean, from 2009 to 2010, but still the same net profit margin of 5%, because there is a very big increase in the operating cost.
Return on assets. This analysis focuses on the earning performance of your enterprise assets. You will need to look into the income statement and balance sheet to compute the ROA. So the ROA determines the earning power of your assets, of your enterprise assets. So the formula for computing the ROA is net profit before tax divided by total assets times 100. As you can see in the balance sheet of Breadwinner for 2009, the total assets amounted to 200,000 pesos. And in the balance sheet of Breadwinner for 2010, the total assets is 312,500 pesos.
The ROA computation for Breadwinner is as follows. ROA 2009 is equal to 30,000, which is the net profit before tax, divided by 200,000, which is the total assets for 2009, times 100 is equal to 15%. And the ROA for 2010 is equal to 62,500, which is the net profit before tax for 2010, divided by 312,500, which is the total assets for 2010, times 100 is equal to 20%, an increase of 5% from 2009 to 2010.
Return on owner's equity or return on investment, ROE or ROI. Return on owner's equity. The earning power of the owner's investment in the business is measured in terms of ratio between the net profit before tax and the owner's equity. The owner's equity is equal to the net assets, or total assets minus total liabilities. So the formula for the ROE is net profit before tax divided by owner's equity times 100. The owner's equity for 2009 is 100,000 and the owner's equity for 2010 is 125,000.
For the computation of ROE for Breadwinner 2009 and 2010, we have the following. ROE for 2009, 30,000 for the net profit before tax, divided by 100,000, the owner's equity, times 100 is equal to 30%. And for 2010, we have 62,500, which is the net profit before tax, and 125,000, which is the owner's equity, times 100 is equal to 50%, an increase of 20% from 2009 to 2010. So from the computations of the ROA and ROE, let us analyze. The ROA in 2009 is 15% and the ROA in 2010 is 20%, an increase of 5%. And in the ROE, in 2009 it is 30%, and from 30% it jumped to 50%, an increase of 20%. So why is it that there is, in the return on assets it's only 5%, and in the return on owner's equity it is 20% increase? Why is it like that? Can you imagine why is it like that? Is there a reason? What is the reason behind that? Perhaps the company is having bigger debts in 2010 than in 2009. They have bigger liabilities. That is why their assets increase. So if their assets have increased significantly, and the net income is in 2009 and in 2010 is the same in the computation of the ROA and ROE, then the ROA has a lesser increase than the ROE. Okay? So we can say that in this case, breadwinner acquired liabilities in 2010, more liabilities in 2010. The percentage of the increase in liabilities is bigger than the percentage of the increase of the investment from the owner's own pocket. You may practice solving the NPM or net profit margin and the ROE or return on owner's equity of Articulante Enterprises for 2018 and 2019. And for the evaluation or assessment of your learning, answer the following. That's all for today. Thank you so much for watching. I hope you have learned something from our discussion. And before I leave, I will give you something to think about. It goes this way, and I quote it from the Bible. Many waters cannot quench the flame of love, neither can the floods drown it. Thank you and God bless.